Hey guys, this is Jesse. Welcome to the live stream today. We're going to be watching the press conference with Jerome Powell following his FOMC meeting, listening to his comments, his remarks, reading between the lines, and catching up with what is going to be going on expected in the markets coming down over the next few weeks. So the conference is a 2-day conference. It happened yesterday and today. And then after the conference, in this case, Jerome Powell gets up in front of the podium, talks about it, they ask some questions from the press, he answers them, and yeah, so it's a super exciting time with lots of thrills, and if you can't sense the sarcasm, then yeah, it can be a little bit dry, but hopefully today, as we listen to him, we'll get to jump in, respond to some of the things he's saying, have some good ideas about what he expects to happen in the future, and yeah, just kind of see where things go. So if you can see on your screen, we're just waiting for the press. It's supposed to start about 2:30 Eastern time. It's about 2:24. I'm in Central Time Zone. I'm in Texas, so I'm an hour behind. It's 1:34 here, and yeah, we're just kind of holding tight while that goes. So if you haven't kept up with what in the last, let's see, 10 months, 12, 13, 14 months, they have increased the rate 5, 6, 7, 8, 9, 10 times. The benchmark rate in March of last year was 0.25 to 0.5%, a quarter to a half. And as of today, it's 5 to 5.25. So it's gone up 4.75%. So that's almost 0.5% every time. So 10 meetings, 10 increases in a row. It hasn't been since March of 2020 since they've seen a reduction. They've dropped the rate 100 basis points March of 2020. They actually dropped it twice in March of 2020. First, they dropped it 50 points, and they dropped another. Was in response to COVID-19. And yeah, the last time, 2015 and 2018, we saw rate hikes, 25 basis points apiece, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. But that was over a span of 3 years. So basically took the same number of rate hikes that we'd seen over 3 years, condensed it down to about 14 months. And this was in response to inflation and the economy. So lots of changes over the last year. We're going to learn more about what they expect to do. Hopefully today, this is going to be the first time in the last 10 meetings that they don't increase the rate. So we'll pause. And they're likely not going to reduce the rate, but maybe let it sit where it is for a while. So Chairman Powell will tell us a little bit more about that. But yeah, just a little background info for you. trading plays while we wait. We'll go to theater mode. Fill the screen up a little bit more. Let's see. I'm using a new streaming software today called Riverside. See if we like it. Here we go. He's coming out. Those are my cheers. It wasn't actually the press people cheering. Just a little sound like. That would be funny though if he walked out, everybody jumped up, started waving their hands in the air. All right. All right. Mr. Powell, let's go.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people.
Typical.
We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since year, the FOMC has significantly tightened the stance of monetary policy. We have raised our policy interest rate by 5 percentage points, and we've continued to reduce our securities holdings at a brisk pace.
5 points over the last year.
We've covered a lot of ground, and the full effects of our tightening have yet to be felt. In light of how far we policy, the uncertain lags with which monetary policy affects the economy, and potential headwinds from credit tightening, today we decided to leave our policy interest rate unchanged and to continue.
So there it is, folks. Increase on this meeting
to reduce our securities holdings. Looking ahead, nearly all committee participants view it as likely that some further rate increases will be appropriate this year to bring inflation down to 2%.
So no increase this time,
and
but
I will have
likely
more to say about monetary policy after briefly reviewing economic developments. The U.S. economy slowed, and recent indicators suggest that economic activity has continued to expand at a modest pace. Although growth in consumer spending has picked up this year, activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear on business fixed investment. Committee participants generally expect subdued growth to continue. In our summary of economic projections, the median projection has real GDP growth at 1.0% this year.
Okay, so let's look at this real quick. There's a range of projections moving forward. 25 longer run. This is the central tendency median projections, and this is historic GDP. So strong in 2021, fell off 22. They're projecting modest growth. Okay.
0.1% next year, well below the median estimate of the longer run normal growth rate. The labor market remains very tight. Over the past 3 months, payroll job gains averaged a robust 283,000 jobs per month. The unemployment rate moved up but remained low at 0.7%. There are some signs that supply and demand in the labor market are coming into better balance. The labor force participation rate has moved up in recent months, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown signs of easing, and job vacancies have declined so far this year. While the jobs to workers gap has declined, labor demand still substantially exceeds the supply of available workers. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on inflation. The median unemployment rate projection in the SEP rises to 4.1% at the end of this year and 4.5% at the end of next year.
Okay,
inflation
so
remains well above our longer-run 2% goal. Over the total PCE prices rose 4.4%, excluding the volatile food and energy categories. Core PCE prices rose 4.7%. In May, the 12-month change in the consumer price index came in at 4%, and the change in the core CPI was 5%. Inflation has moderated somewhat since the middle of last year. Nonetheless, inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. The median projection in the SEP for total PCE inflation is 3.2% this year, 2.5% next year, and 2.1% in 2025. Core
okay,
PCE.
I'm going to rewind just a little bit. So PCE inflation. They're expecting to come down to 2% towards the end of 2025. Get down to low twos
in 2025.
2.1%.
Core PCE inflation, which excludes volatile and food and energy prices, is projected to run higher than total inflation, and the median projection has been revised in the SEP up to 3.9% this year. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets.
Yeah, we're down to 4.5. That's what
monetary policy actions are guided by our mandate to provide maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we've raised our policy rate by 5 percentage points.
Yeah, we talked about that before.
We have been seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, especially housing and investment. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. The economy is facing headwinds from tighter credit conditions for households and businesses, which are likely to weigh on
So he's talking about tighter credit conditions here, and that's related to the recent bank failures and lenders and creditors just being more restrictive on how they lend money,
economic
and it's affecting both businesses and
activity,
consumers.
hiring, and inflation. The extent of these effects remains uncertain. In light of how far we've come in tightening policy, the uncertain lags with which monetary policy affects the economy, and potential headwinds from credit tightening, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5 to 5.25% and to continue the process of significantly reducing our securities holdings. As I noted earlier, nearly all committee participants expect that it will be appropriate to raise interest rates somewhat further by the end of the year. But at this meeting, considering how far and how fast we've moved, we judged it prudent to hold the target range steady to allow the committee to assess additional information and its implications for monetary policy. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial
Lags in
developments.
policy.
In our SEP, participants.
So the lags in policy, which is something that I've heard a lot of people harp on recently, is you're doing all this work, you're raising the rate, but you're not giving it any time to work through the system and actually affect people, to affect businesses, to affect consumers, to affect markets. So why are you going to keep raising the rates so aggressively if over time, the course of time, you're not letting it trickle out? So March of 2022, we saw a quarter point increase. Then we saw a half a point, then 3 point, 3/4 point, 3/4 point. So 1, 2, 3, 4, 5, 6. In the first 6 increases, so what is that? That's 3 plus, 3 plus 0.5 plus 0.25 divided by 6. So we saw, that can't be right. 1, 2, 3, 4, 5, 6. 3 plus 0.5 plus 0.25 divided by 6. We saw an average of 0.5% rate increase per increase on the first 6 increases. It moved so quick, and then they another 0.5%, then quarter percent. So the criticism is, if you're doing all these rate increases, when are we actually going to know if it's working, if it's taking effect? You're not able to let it move through the system and work its way through everything before you keep increasing the rates. So the fear is, if you're increasing them aggressively, by the time we realize it's affecting everything and that it's having the intended effect on the economy, you increase them another 1, 1.5, 2%, and now we push them too high and people are experiencing too much pain. So he has received over the last, I would say, 6 to 9 months of and maybe as far as 12 months, you've done all this work. Now stop and let it have its intended effect. And I think from his perspective, the fear is, if we pause, then an inflation, then we're going to lose ground and we're going to extend this out. It's going to be even more painful down the road. So I don't know what the right answer is. Do you keep doing the increases, which is what they ended up doing, and wait on the pause, or do you pause earlier and let it work out? It sounds like now he's saying, hey, we're at 5 to 5.25% on the target rate. We're going to pause here. We're going to let things work out. And I'm glad he is. I think a lot of people would have said, should have done this 6 months ago.
Wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward.
So this scatter plot, if you didn't hear what you just said, is members of the Federal Reserve Board all put in what they think their prediction is going to be through the highest point for the year. So if you look at this 2023, most people look like they're expecting around 5.75 as the high target. That's where it's going to get up to. The next year, 2024, it looks like there's the most people in maybe 4.25%. The next year for 2025, there's a lot of discrepancy on where people think the rates are going to go, but it looks like mostly in the low. If you look at this, it looks like of 3 years it's going to trend down, where the Federal Reserve rate is going to get back into the twos. Now, I would guess that this person up here voting at a low sixes is probably the same person is taking this conservative route, saying it's going to be in the high fives. And maybe the same with one of these. This person is probably the same person saying mid threes to low twos. That seems good. So they're kind of expecting that spread between the most conservative and least conservative approach is big. 2025 is a long ways away, but this is essentially where people are expecting the rates to get to this year.
If the economy
next year,
evolves
the year after,
as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.6% at the end of this year, 4% at the end of 2024, and 3.4% at the end of 2025. For the end of this year, the median projection is a 0.5 percentage point higher than projections. I hasten to add, as always, that these projections.
So the March projections that they put out, this same plot in March was lower. It sounds like it was around 5.25, and now it's 5.75.
These are not a committee decision or plan. If the economy does not evolve as projected, the path for policy will adjust as appropriate to foster our maximum employment and price stability goals. We will continue to make our decisions meeting by meeting based on the totality of incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do at the Fed is in service to our public mission. We will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
All right, question time.
Thank you. Colby Smith with the Financial Times. I'm curious what gives you and the committee the confidence that waiting will not be counterproductive at a time when the monthly pace of core inflation is still so elevated. Interest rate sensitive sectors like housing, while they felt the drag of the past Fed actions, have started to recover in some regions, and financial conditions, most recently were easing.
Not gonna lie, I didn't listen to what you were saying at all.
I guess I would go back to the beginning of this tightening cycle to address that. So as we started our rate hikes early last year, we said there were 3 issues that would need to be addressed kind of in sequence. And that of the speed of tightening, the level to which rates would need to go, and then the period of time over which we'd need to keep policy restrictive. So at the outset, going back 15 months, the key issue was how fast to move rates up, and we moved very quickly. By historical standards. Then last December, after 4 consecutive 75 basis point hikes, we moderated to a pace of basis point hike, and then this year to 3 25 basis point hikes at sequential meetings. So it seemed to us to make obvious sense to moderate our rate hikes as we got closer to our destination. So the decision to consider not hiking at every meeting and ultimately to hold rates steady at this meeting, I would just say it's a continuation of that process. The main issue that we're focused on now is determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time. So the pace of the increases and the ultimate level of increases are separate variables. Given how far we have come, it may make sense for rates to move higher, but at a more moderate pace. I want to stress one more thing, and that is that the committee decision made today was only about this meeting. We didn't make any decision about going forward, including what would happen at the next meeting, including we did not decide or really discuss anything about going to an every other meeting kind of an approach or really any other approach. We really were focused on what to do at this meeting.
So he's saying there not to read into this or make any jumps to conclusions or assessments on what to expect
kind of
next meeting, or
initial
if there's
debate
going to be a
about the
different
possibility
pattern
of
in what they
July?
raise
Any
rates.
sense of the initial support at
Very
this stage for that
want to
move?
give
So
too
again, we
much
didn't
information
make a
away.
decision about July. I mean, of course, it came up in the meeting from time to time, but really the focus was on what to do today. I would say about July, two things. One, decision hasn't been made. Two, I do expect that it will be a live meeting.
Thanks, Howard Schneider with Reuters. I was just wondering if you could help us understand the narrative here, because it feels like there's been a level shift in the dots. Stronger GDP, unemployment, slower progress on inflation, and I'm wondering in this sort of where's the disinflation coming from?
Sure.
The labor market's going to be stronger. It looks like it's not coming from there. Demand is not coming down all that fast, according to GDP. You've doubled your estimate of GDP. So what's the narrative here? It seems like it's getting more immaculate rather than more messy.
So you're right that the data came in, I would say, consistent with, but on the high side of expectations. So, and if you go back to the former SEP, the last SEP in March, you will see that growth moved up. These are not huge moves, but growth estimates moved up. Employment estimates moved down a bit. Inflation estimates moved up a bit. And, all three of those kind of point in the same direction, which is, that perhaps more restraint will be necessary than we had thought at the last meeting. So although the level, frankly, is pretty, the level of 5.6 is pretty consistent if you think about it, where the federal funds rate was trading before the bank incidents of early March. So we've kind of gone back to that. So your question is, where's the disinflation going to come from? And I don't think the story has really changed. The committee has consistently said and believed that the process of getting inflation down is going to be a gradual one. And
And if you remember that graph we looked at earlier, it's not until 2025 and beyond that it gets back in that 2% range.
I think you go back to the three-part framework for core PCE inflation, which is, we think, as good an indicator as you can have for where inflation is going forward. You start with goods. With goods, we need to see supply side conditions. They've definitely improved a substantial amount, but if you talk to people in business, they will say it's not back to where it was. So that's one thing, and that should enable goods prices to continue, goods inflation to continue to come. In terms of housing services inflation, that's another piece, and you are seeing there that new rents, new leases are coming in at low levels, and it's really a matter of time as that goes through the pipeline. In fact, I think any forecast that people are making right now, that inflation coming down this year will contain a big dose of, this year and next year will contain a good amount of disinflation from that source, and that's, again, probably going to come slower than we would expect. That leaves, the big sector, which is a little more than half, pardon me, of core PCE inflation. That's non-housing services, and we see only the earliest signs of disinflation. It's a sector. It's a very broad and diverse sector. I would say in a number of the parts of that sector, the largest cost would be wage costs. It's the service sector, so it's heavily labor intensive, and I think many analysts would say that the key to getting inflation down there is to have a continuing loosening in labor market conditions, which we have seen. I go through a number of indicators suggesting there's been some loosening in labor market conditions. We need to see that continue. I would almost say that the conditions that we need to see in place to get inflation down are coming into place, and that would be growth meaningfully below trend. It would be a labor market that's loosening. It would be goods pipelines getting healthier and healthier and that kind of thing. The things are in place that we need to see, but the process of that actually working on inflation is going to take some time.
Nick.
Nick Tamaros of the Wall Street Journal. Chair Powell, what's the value in pausing and signaling future hikes versus just hiking now? I mean, not to be flippant, but I don't lose weight just by buying a gym membership. I have to actually go to the gym. 16 of your colleagues put down a higher year-end 23 rate today. A majority think you're going to have to go up by 50 basis points this year. So why not just rip off the Band-Aid and raise rates today?
So first, I would say that the question of speed is a separate question from the question from that of level. Okay, so
This was the same thing that we were talking about earlier. Is I bet he's about to talk about letting it work through the system. Let's see.
and I think if you look at the SEP, that is our estimate, our individual, it's really accumulation of our individual estimates of how far to go. I mentioned how we got to those numbers. In terms of speed, it's what I said at the beginning, which is speed was very important last year. As we get closer and closer to the destination, and according to the SEP, we're not so far away from the destination in most people's accounting. It's reasonable, it's common sense to go a little slower, just as it was reasonable to go from 75 basis points to 50 to 25 at every meeting. And so the committee thought overall that it was appropriate to moderate the pace, if only slightly. And there are benefits to that. So that gives us more information to make decisions. We may try to make better decisions. I think it allows the economy a little more time to adapt as we make our decisions going forward, and we'll get to see. We don't know the full extent of the banking. We've seen it would be early to see those, but we don't know what the extent is. We'll have some more time to see that unfold. I mean, it's just the idea that we're trying to get this right, and
then let it work.
This is if you think of the two things as separate variables, then I think that the skip the decision.
I wonder why you said you shouldn't call it a skip.
I know you said July
skip
is
implies
live
that
with
you're going to
only
do it
one
again next one.
June employment, with only the June employment and the CPI report for June due to be released before the July meeting. You get the ECI after, you get the senior loan officer survey after, you get some bank earnings at the end of next month. What incremental information will the committee be using to inform their judgment on whether this is in fact a skip or a longer pause?
Well, I think you're adding that to the data that we've seen since the last meeting too. Since we chose to maintain rates at this meeting, it'll really be a 3-month period of data that we can look at. And I think that's a full quarter, and I think you can draw more conclusions from that than you come from any 6-week period. Mm-hmm. We'll look at those things. We'll also look at the evolving risk picture. We'll look at what's happening in the financial sector. We'll look at all the data, the evolving outlook, and we'll make a decision.
Gina.
Thanks for taking our questions. Gina Smilek, New York Times. You obviously in your forecast marked up the sort of path for growth, marked down the path for unemployment, marked up the path for inflation pretty notably. I wonder, since March, what has changed to make you think that the economy is a lot more resilient and inflation is going to be a lot more stubborn? And given that, why do you feel confident that this is as high as you're going to have to revise the federal funds rate, or do you think it's possible we could have even a higher than 5.6% terminal by the end of this cycle?
She's notorious for just saying, I wonder, and then following it with a thought, but not actually asking the question.
And also the outlook, the economy the labor market, I think, has surprised many, if not all, analysts over the last couple of years with its extraordinary resilience, really. It's just remarkable, and that's really, if you think about it, that's what's driving. It's job creation, it's wages moving up, it's supporting spending, which in turn is supporting hiring, and it's really the engine, it seems, that is driving the economy. So it's really the data. In terms of we always write down at these meetings what we think the appropriate terminal rate will be at the end of this year. That's how we do it. On our own individual assessments of what the most likely path of the economy is, it can actually in reality wind up being lower or higher, and there's really no way to know. But it's what people think as the data come in, it can move around during the intermeeting period. It could wind up, but it really will be data driven. I can't tell you that I ever have a lot of
30 minutes, but he got to it.
See where the federal funds rate will be that far in advance.
Mr. Chairman, thanks for taking my question. You had said back at the end of May that you thought we're getting closer to being into balance. Is that still the case, or has your mind changed about the balance of risks out there? And also, could you give us an idea of what would be a sufficiently restrictive funds rate? Obviously the current rate, according to the committee, is not sufficiently restrictive. Is it 5.6? Is it 6 words or sufficiently restrictive? Thank you.
I would say again that I think that over time, the balance of risks as we've moved from from interest rates at effectively zero now to 5 percentage points with an SEP calling for additional hikes, I think we've moved much closer to our destination, which is that sufficiently. And I think that means, almost by definition, that the risks of sort of overdoing it and underdoing it are getting closer to being in balance. I still think, and my colleagues agree, that the risks to inflation are to the upside still. So we don't think we're there with inflation yet. We're just looking at the data. If you look at the full range of inflation data, particularly the core data, you just aren't seeing a lot of progress over the last year. Headline, of course, inflation has come down materially, but as you know, we look at core as a better indicator of where inflation overall is going. Sufficiently, so I think what we'd like to see is credible evidence that inflation is topping out and then beginning to come down. That's what we want to see. Of course, that's what we want to see, and I think it's also, we understand that there are lags, but remember that it's more than a year since financial conditions began tightening. I think the reason we're comfortable pausing is that we are still, much of the tightening took place over last summer and later into the year, and I think it's reasonable to think that some of that may come into effect. So we're I think stretching out into a more moderate pace is appropriate to allow you to make that judgment of sufficiency, with more data over time.
Rachel.
So letting it work through, letting the lags work through and see where things come out the other side.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. I wanted to ask further on the lag effects. When you're considering when you would hike again throughout the course of the year, are there things that you would expect to kick in as those lag effects come into effect that would inform your decisions? Have you learned things over the past year that give you some sense of timeline for when to expect those lags to come into effect?
Yeah. So it's a challenging thing in economics. It's sort of standard thinking that monetary policy affects economic activity with long and variable lags. Of course, these days, financial conditions begin to tighten well in advance of actual rate hikes. So if you look back when we were lifting off, we started talking about lifting off. By the time we had lifted off, the 2-year, which is a pretty good estimate of where policy is going, had gone from 20 basis points to 200 basis points. So in that sense, tightening happens much sooner than it used to in a world where news was in newspapers and not on the wire. So that's
not live
but
streamed
it's
on
still the
YouTube with
case
some
that
guy
what you
talking
see
in
is
a microphone
interest-sensitive
about
spending is
what he
affected very,
thinks.
very quickly. So housing and durable goods and things like that. But broader demand and spending and asset values and things like that, they just take longer. And you can pretty much find research to support whatever answer you would like on that. So there's not any certainty or agreement in the profession on how long it takes.
So non-committal on how long it
and
takes.
that makes it challenging, of
these
course. So
changes
we're
will take place
looking
to
at the
work through all
calendar, we're
systems.
looking at what's happening in the economy. We're having to make these judgments. And again, it's one of the main reasons why it makes sense to go at a slightly more as we seek that ultimate. I can't point to that ultimate endpoint. I can't point to a specific data point. I think we'll see it when we see inflation, really, really flattening out reliably and then starting to soften. I think we'll know that it's working. And ideally, by taking a little more time, we won't go well past the level where we need to go.
I was curious if you could give us an update on what you're seeing on the bank incidents for March and how you're teasing that out apart from these lag effects.
So it's too early still to try to assess the full extent of what that might mean. And that's something we're going to be watching, of course. And if we were to see what we would view as significant tightening beyond what would normally be expected because of this channel, then we would factor that into account in making rate decisions. So that's how we think about it.
Let's go to Chris.
Thanks. Chris Rugaber at Associated Press. You mentioned that many of the trends are in place that you want to see. Core services ex housing has come in pretty low in the past couple of months. And as you noted, a significant portion of core inflation is now housing prices. And then we've had some quirks in used car prices. So given that these trends are in place, I guess I'm sort of asking the flip side of Nick's question, why signal additional rate hikes? Aren't things headed in the direction you need? Why not simply give it even more time? Or I mean, it's surprising to see so much hawkishness in the dots, given what we're seeing recently.
Yeah. So, we've, remember, we're
If you don't remember, Nick's question was the
2.5
one
years
about.
into this, or 2.25 years into
Oh,
this,
no, it's
and
not pausing.
forecasters
Come
include.
on. Nick's question was the one about, if you think you're going to raise it, why not just rip the Band-Aid off and raise it now instead of waiting to tick it up over the course of the year?
Including Fed forecasters have
And this question is, if things are trending in the right direction, why are you even signaling?
definitely thought that inflation was about to turn down, and traditional, not typically forecasted that it would, and been wrong. So I think if you look at core PCE inflation overall, look at it over the last 6 months, you're just not seeing a lot of progress. It's a level, over 4.5%, far above our target, and not really, moving down. We want to see it moving down decisively. That's all. Of course, we are going to get inflation down to 2%. We don't want to do. We want to do that with the minimum damage we can to the economy, of course. But we have to get inflation down to 2%, and we will. And we just don't see that yet. So, hence you see today's policy decision, both to write down further rate hikes by the end of this year, but also to moderate the pace with which we're moving.
Quick follow-up. I mean, the last press conference you mentioned you didn't see wages driving inflation, and there was some research from the Fed suggesting wages aren't necessarily a key driver, but you've talked about the labor market today and the need for softening. Can you give us a little more specifically of how you see the tight labor market driving inflation at this point? Thank you.
Right. So I'm not going to comment on any particular. I would say that I think the overall picture is that at the beginning in 21, inflation was really coming from very strong demand largely for goods. People were still at home. They had money in the bank and they wanted to spend. They spent a lot on goods. And of course, at the same time, and because of supply chains got all snarled up. So prices went way up, inflation went way up. So that was the origin. And it wasn't really particularly about the labor market or wages. But as you moved through 21 into 22 and now in 23, I think many analysts believe that it will be an important part of getting inflation down, especially in the non-housing services sector, to getting wage inflation back to a level that is sustainable, that is consistent with 2% inflation. We actually have seen wages broadly move down, but just at a quite gradual pace. So, and that's a little bit of the finding of the Bernanke paper of a few weeks ago, which is very consistent with what I would think.
Let's go to Michael McKee.
Michael McKee from Bloomberg Radio and Television. You said in the past that you don't like to surprise markets. It's kind of the Fed's view. Markets should have an idea of what you're going to do before you go in. You also said a number of times that it would take a while to bring inflation down. You reiterated that again today, and that we would get to a point where inflation could be sticky. So I'm wondering, as we go into the next meetings, how Wall Street or others should look at your reaction function. What will you be reacting to, time or data? In other words, if nothing much changes, if we're looking at the same sort of labor market, the same sort of levels in July or in September or November, will you move because you've said you feel you need to? Is it time that's going to require additional movement, or would it be a reversal in inflation?
So I don't want to deal with hypotheticals about different ways data might move out. So we don't go out of our way to surprise markets
that
or
there's going to be
public.
another
At
increase.
the same time, our main focus has to be on getting the policy right, and that's what we're doing.
Is it
here,
more
and that's
going to
what
be
we'll do
influenced
for
by the amount of
upcoming
time
meetings. I will
since
say
the last
July
increase,
meeting will be live,
or
and
the metrics that you measure?
we'll just have to see. I think you'll see the data, you'll hear Fed people talking about it, and make a judgment.
Well, do you think inflation is likely to continue coming down based on the lags and based on your threat of additional movement? Or are we going to be in a period where we're not going to know what's happening?
I think if you look at if you just look at forecasts, so inflation is running, core PCE inflation is running at about 4.5%, a little higher than 4.5%, and the median FOMC participant thinks it'll go down to 3.9 on a 12-month basis. This is by the end of this year. So that's expecting pretty substantial progress. That's a pretty significant decline for half a year. So that's the forecast. We do try to be transparent in our reaction function. We're committed to getting inflation down, and that's the number one thing. So that's how I think about it.
Let's go to Victoria.
Victoria Guido with Politico. Could you talk about the balance sheet and how you're thinking about it? What are you looking for to judge whether we're approaching reserve scarcity, and is Treasury issuance going to affect that? Also, are you considering lowering the RRP rate in order to take some pressure off banks?
So let me say, first of all, on the Treasury part of it, if I can talk about that, and then go back to the balance sheet. So on that, of course, we've been very focused on that for a couple of months, as everyone has. Treasury has laid out its borrowing plans publicly.
So she was asking about the Federal Reserve not only sets rates for the overnight rate for banks, but they also hold some assets. And when the economy is weak, they'll go out and start buying up assets. And by assets, I mean securities. They'll start buying financial commodities. And what that does is it can artificially prop up the market. So if nobody's buying or everybody's selling because there's concerns about the economy being bad, they'll go and they'll buy up these securities, they'll buy up these financial commodities. And what that does, it creates demand. So when supply gets really high and there's no demand, the price comes down. But in order to keep the price from coming down too high, they'll come up and prop up demand by buying it themselves so that the price doesn't bottom out too low. Now, what they've done, and this is one of the reasons that mortgage rates have started to increase, is they've started selling off these financial commodities they have, these mortgage securities. They've been offloading them off their balance sheet. And so the opposite now, they're adding to the supply and demand is coming down because they're no longer buying. Now they're also selling. And what that does is it drives the value of those things down, which they had to do because they'd accumulated so many, but they're also trying to get back into a more balanced position. And that when she asked about getting things off the balance sheet.
I think I saw the Secretary's comments yesterday to the effect that Treasury has consulted widely with market participants about how to avoid market disruption, and that they're going to watch carefully for that. So that's from the Treasury, which actually sets the borrowings. At the Fed, we'll be monitoring market conditions carefully as the Treasury refills the TGA. The adjustment process is very likely to involve both a reduction in the RRP facility and also in reserves. It's really hard to say at the beginning of this which will be. We are starting at a very high level of reserves and still elevated RRP to take up, for that matter. So we don't think reserves are likely to become scarce in the near term or even over the course of the year. So that's the Treasury part of the answer. We will, of course, continue to monitor conditions in money markets, and we're prepared to make adjustments to make sure that monetary policy transmission works. Was there another part of your question?
Yeah. What are you considering lowering the RRP rate to help take some pressure off banks?
So we have a number of, I would say, the RRP doesn't look like it's pulling money out of the banking system. It's actually been shrinking here lately. So I don't think that's not something we've thought about a lot over time. It doesn't really look like that's something that we would do. I think it's a tool that we have. If we want to use it, we can. There are other tools we can use to address money market. It's something that's likely that we would do in the near term.
Janelle Marte with Bloomberg. Have you seen sufficient cooling in the housing market to bring inflation down? How does the recent rebound affect your forecast, and how does it factor into monetary policy?
So certainly housing, very interest sensitive, and first place really, or one of the first places that's either helped by low rates or that is held back by higher rates. And we certainly saw that over the course of the last year. We now see housing putting in a bottom and maybe even moving up a little bit. We're watching that situation carefully. I do think we will see rents and house prices filtering into housing services inflation, and I don't see them coming up quickly.
Uh-oh, I froze. I was doing too many things with my computer.
I do wandering around at a relatively low level now, and that's appropriate.
Do you think you'll have to target that with further rate increases?
Well, I think we look at everything. We don't just look at housing. So I think, the way it works is individual participants sit in their offices all over the country and they write down their forecast, and including their most likely forecast, including their rate forecast. And then Friday afternoon, and we accumulate it and then we publish it for you. So that's how they do that. Well, I don't know that housing is itself going to be driving the rates picture, but it's part of it.
Thank you for taking the question, Mr. Chairman. Edward Lawrence with Fox Business. So I want to go back to comments you made about in the past about unsustainable fiscal path. The CBO projects the federal deficit to be 2.8 trillion in 10 years. The CBO also says that federal debt will be 52 by 2033. At what point do you talk more firmly with lawmakers about fiscal responsibility? Because I'm assuming monetary policy cannot handle alone the inflation or keep that inflation in check with the higher level spending.
I don't do that. That's really not my job. We hope and expect that other policymakers our independence on monetary policy, and we don't see ourselves as the judges of appropriate fiscal policy. I will say, and many of my predecessors have said, that we're on an unsustainable fiscal path, and that needs to be addressed over time. But I think trying to get into that with lawmakers would be kind of inappropriate, given our independence and our need to stick to our knitting.
Is there any conversation then about the Federal Reserve financing some of that debt that we're seeing come down the pike?
No, under no circumstances.
Courtney.
Thanks for taking our questions, Chair Powell. So looking at the SEP, it looks like GDP for this year was raised significantly, your forecast for GDP this year. The unemployment rate, meanwhile, was pulled downward. And so should we take that as a sign that the committee is more confident about the prospects of a soft landing, at least as it relates to what you were expecting in March?
I would just say it this way, that I continue to think, and this really hasn't changed, that there is a path to getting inflation back down to 2% without having to see the kind of sharp downturn and large losses of employment that we've seen in so many past instances. It's possible. In a way, a strong labor market that gradually cools could aid that along. It could aid that along. But I guess I want to come back to the main thing, which is though simply this: we see the committee, as you can see from the SEP, the committee is completely unified in the need to get inflation down to 2%, and will do to get it down to 2% over time. That is our plan. And we understand that allowing inflation to get entrenched in the U.S. economy is the thing that we cannot allow to happen for the benefit of today's workers and families.
So we're going to start to wrap it up. There's probably a few more questions. I would bet this press conference goes on for another 10 or 15 minutes. But so the bulk of the meeting today, no increase, a pause. He didn't say skip. He tried to stay away from that. So there wasn't an implication to happen the next one. he did. Forecasts are still that there will be an additional rate increase. He got questions about why don't you just do it now, or what are you going to look for in the data when you decide to make that increase down the road? And really non-committal, like we're not going to do it now because we've been slowing down. They've been tapping the brakes, and the velocity of increases is to the point where they don't need to do it now. They can slow down enough where they do not have an increase this meeting. And the data could change and they could not increase. The next time that the meeting happens, they could say, oh yeah, we're good where we are. Overall, they're letting all of the increases and all of the different factors that have been going on in the financial markets to work themselves out in play. He feels like they're getting to a spot where rates are in a good spot for now. And depending on how the markets react and how everything starts to work through the systems will dictate when and how much they have the next rate increase. So overall, kind of what people expected. But here's an interesting thing, and I'm going to share a different screen of mine. But I want to show you guys what the markets have done since this meeting started. So if you take a look at this screen, this was at 2 p.m. Eastern time. So 30 minutes before the meeting started at 2:10, the market had dropped 0.3 of a point, 0.17, 100.62, 101.17. It had dropped 0.5%. And then since the meeting has started at 2:30, it has slowly come back up. Overall, the market is still down. Mortgage rates, mortgage securities are still down 0.25%. The other interesting thing is this treasury note is down. Usually, mortgage rates follow the treasury notes. And so when the treasury notes go down, mortgage rates go down. So some weird stuff happening on the market today, a little bit of extra volatility. If you look at the past week, this is this week so far, a couple red days. Monday was good. The last 2 days were red. We've come off a very horizontal week. So not really sure what looks like. The markets are having a lot of mixed reactions to what the Fed did and what they've said in the press conference. And there's not a really clear indication of how people are going to respond over the next few days. So I will keep you guys posted. If you have any questions, as always, don't hesitate to reach out. Cell phone is best. If you don't have my cell phone number, send me a message. I'll send it over. I do a Monday market update for real estate agents every week. I send it out via text message, my pretty face on a video for about 1 minute, letting you know what happened the week before and what's coming up. So Monday's video will absolutely have a recap of this Fed meeting and what to expect. And hopefully by Monday, we'll have a couple more days for everything to trickle through and see like what's going on and what to expect. So thanks for joining me today. Thanks for hanging out and watching. And yeah, until next time.